Great, thank you. As Rob said, my name is Ronit. I work for Citi. Just to be clear, I'm not here to give a corporate pitch for Citi. I want to talk a little bit about how the banking industry is changing and how technology is pushing the banking industry to yet another major challenge. And to put this into a broader context, particularly a slightly non-tech context, the problem for the incumbent industry is that the disruption from the tech, particularly big tech space, and the changing consumer behavior, including in new tech, is coming at a worst possible time for many banks. And this is particularly true in the UK and Europe. So from a finance guy's perspective, to get money, you have to return above your cost of capital. Banks over the last 5 years in Europe have made how much? In terms of return on equity, they've made 5% on average over the last 5 years. Now, if you're an investor and your industry is returning 5% today, you're getting back half of what you expect. Slightly better in the US. In the US, it's about 10%, and it's rising with the growth in the economy, tax cuts. But in Europe, including the UK, you're talking about 5%. And this is before any revenue loss from market share loss to TechFin or FinTech. This is before further spending costs. And one of our main themes at Citi Research is that we think over the next couple of years, banks are going to have to spend more and more money in tech to compete with the challenge they're facing from non-traditional competitors. So we think, particularly in developed markets such as Western Europe and the US, it won't be a case of lots of revenue loss. It'll be a question of significant extra spending, pushing up costs in the short term, hurting profit margins. Very different picture when you look at emerging markets like India or Southeast Asia or middle-income countries like China. There you're talking about potential and already revenue loss. Now, part of the theme I'm going to talk about is the difference between walking the walk and talking the talk, as the Americans like to say. And I worked in an American company for 20 years, and bank CEOs are really getting into talking the talk on technology. It's a bit like, we tell our kids, have your vegetables, or I tell myself, go to the gym. Bank CEOs are the same when it comes to tech right now. So, got a quote there from Lloyd Blankfein, the CEO of Goldman Sachs. We are a tech company. Oh, okay, fine, we're a tech company. I think more relevant is the one here at the bottom right-hand corner from the CEO of Barclays in the UK. The traditional boundaries of what industry I'm in are fading away. That's a better description of the situation bankers are in. Also from the Citibank, can we be competitive against technology companies? So a lot of bankers are talking about we are a tech company in conferences on CNBC. But banks are the biggest clients of tech companies. They are not tech companies. Banks are the biggest spenders on technology as any industry goes in the world. So they're very important in the tech ecosystem, but typically as clients rather than as tech companies themselves. When bankers say, oh, we're a tech company, one of the anecdotes they bring up is, do you know how many people we have working in our tech department? Or do you know how many technologists we have, or how many software developers we have? The problem is that doesn't make you into an innovative company. I've stolen something from Peter Thiel, a book I read. I'm sure some of you have read this, 0 to 1. He talks about, he's not the only one to talk about this, but what is the definition of progress? There's two ways of doing, very simplistically, progress. One is you do brand new things, so you go from 0 to 1. Or you copy. You copy things that work. You go from N to 1. Now, once upon a time, a long, long time ago, well, about 15 years ago, banks were very good at doing new things. In fact, they did so many new things that many of them went bust. They were very good at taking on risk. But because of the financial crisis, banks have become really bad at not just doing 0 to 1, really innovative stuff, but even N to 1, just copy-paste. Doing something new in a different business area or copying something from an existing business area to another new business area, very difficult. Taking something from an existing country you're operating in to a new country, very difficult. Banks have not only forgotten how to do 0 to 1, they're finding it very difficult to do N to 1. Now, a long, long time ago, banks are very good at doing new things. And I just wanted to remind you of banks were ultimate risk takers. So this is globalization in the 19th century. This is just a picture of Standard Chartered. I was going past it in India recently, in Kolkata. So back in the 19th century, as at least the UK expanded around the world, the banks followed. The banks went to new countries, brand new cities, set up operations. Chartered Bank, now Standard Chartered Bank, set up in India, 1858, next year in Hong Kong here. My own company, a predecessor of my own company, the International Banking Corporation, which was our international arm, opened in India and China in 1901, 1902. They followed the American corporate expansion. And we went to some pretty interesting places. This is, if you can't guess from the size of the ties, this is from the 1970s. We were in Iran in the 1970s. Banks went around the world. Banks were also pretty early adopters of technology. But the problem with being an early adopter of technology is this is what you've ended up with. This is a great picture we've taken from Rabobank. This is with using Lego and strings, an illustration of their core IT infrastructure. I don't know if you can see it from the back, but this is one of my favorite pictures. So by starting out with 1960s technology, this is what you're left with as your infrastructure. So you're in a technology trap. It's very hard to innovate when your core systems look like that. And you're also in a regulation and organizational trap. For those of you who are crypto enthusiasts, this is in the Genesis block. But what's interesting for me isn't the crypto revolution potentially that this has led to. What's interesting for me is that at the same time as you get this fundamental technology change, the banks go into freeze. They go into deep freeze. Because of the events of 2000 2008 and 2009, the problem the banks ran into isn't that you get a lot of tech enthusiasts who come and try to take away their business. It's that for 10 years, most of the senior management are dealing with the fallout from the 2008, 2009 crisis. That means most of the senior managements are not thinking about innovation. They might hire people to become heads of innovation in the last few years. They might set up ventures units. But their bottom line is to think about how do I manage the regulatory and political backlash of this crisis? And if you think about the numbers involved, this makes total sense. I don't know, a lot of you are based in Hong Kong or Asia. I don't know if you've followed the amount of money that US and European banks have spent on fines and regulatory charges. I don't know if you've got any idea of the scale of that. So just in the UK alone, since the financial crisis, the UK banks have paid fines of, guess how much? Anyone got a number? Come on, Claire, what's the number? UK banks' fines since the financial crisis. 10 billion? Higher. 50 billion, I think. 50. Lower, no, it's higher than 50 billion. Anyone got a higher number? It's $100 billion. I guess I didn't say which currency. 100 billion US dollars, not Hong Kong dollars. So if you're a CEO of a bank, any bank in the UK, and someone comes along and says, oh, FinTech is going to disrupt you in the last 10 years, you're thinking, I'm spending $100 billion on fines and regulatory charges from the UK because of PPI, mis-selling, from the US for various capital markets misdemeanors. How much am I going to lose from FinTech? $1 billion? A couple of billion? Anyway, the future CEOs can handle this. So this has been the biggest challenge for the banking industry, is that the senior management, the boards, have spent most of the last 10 years focused on the fallout of the financial crisis. And while this has been happening, most of you in the audience, obviously, you spent two days listening to what's happening in the industry. There's a fundamental change going on, particularly in the consumer banking space, because of the social, mobile, cloud revolution. And we think that this has a major impact in terms of revenues lost in particularly emerging markets. Let me just explain this chart. So this is how we see the world in terms of the impact on the incumbent banking industry from new technology players. If you're in countries, there's two axes here. One is showing you digitization. The other axis is showing you the level of retail banking sophistication or consumer sophistication the existing industry has. If you're in the bottom right-hand quadrant, you're in markets such as China, which have become highly digitized, but the incumbent banking industry or the incumbent finance industry are in the Stone Age when it comes to consumer sophistication. They're typically corporate or SOE-focused companies. Here, you're going to lose revenues. You're going to lose market share as revenues grow, as new revenue streams grow, so e-commerce payments grows. You as a bank, you give away a lot of that market share to new entrants, typically tech-based entrants. So consumer banks in the bottom right-hand quadrant face a lot of trouble. In the top right-hand quadrant, you face, and this is the UK, you face revenue pressure, but not because of necessarily large market share losses, but because of pricing pressure in our view. Because what FinTech does, or technology in general does, is increase transparency. So you're gonna see further pressure on top line because of margins. And there's another axis. I'm not clever enough to do three-dimensional pictures. So on the last picture, on the last chart I showed you, you had two axes. Basically, if you're in a digitized country where the consumers are digitized but the banks are not, you're going to lose out. But the other axis is how quickly is your society changing? And this is the biggest challenge for banks in transitional economies or emerging markets, is that your society is fundamentally changing, so you can create 10x opportunities in consumer. The challenge that FinTech startups have, or B2C players have in the UK or Northwest Europe or the US, is that there isn't that big mass market scope for 10x opportunities. And we can discuss that maybe over drinks. I think I'm standing between you and drinks, so we can maybe discuss that over drinks. But we think that in B2C, in developed markets, you have niche opportunities. Again, in the UK, FX providers, traditionally banks have charged a lot of fees for FX. So guess what? Revolut comes along. You have lots of interesting niche business opportunities, but mass market business opportunity, B2C, you need to be in a country where the banks are relatively asleep and there's big social change. I'm going to skip through some of these slides. Now, so the senior bankers spend much of the last decade saying, we've got other things to worry about, so you can put it into a kind of a denial phase, the sort of 4 or 5 stages of grief. You're in a denial stage. Then they get into an anger stage, which is, look, all these fintechs are really cool, but we have the clients. Where are your clients? You've got interesting products, but we have the clients. Now, the problem for some of the banks has become is, and this is not so much fintech, but techfin, is that many of these technology companies now have more clients and a stronger brand than the banks. And you could obviously, this is a China example it's a couple of months out of date with WeChat and Alibaba. You can see the Korea takeoff for Kakao Bank. Some of you will be familiar with that. The banks can no longer say, but we have the clients. Because the social media companies, the internet companies, the tech fins have clients, and particularly in payments and payment-related financial services products, this has given them a real entry opportunity. The next big thing to watch in this space is probably in the next month or so, Paytm will go live with payments in India. Now, it's been discussed since last summer, but WhatsApp will go live. Paytm's obviously, over 250 million people in India use, pretty much most urban Indians use WhatsApp. WhatsApp going live will be, I think, a really significant development at a global level for Facebook and WhatsApp. Similarly, Google with their M-Wallet, the Tez wallet, is an interesting development. It's only 12 million clients so far, but it's growing fast. Now, the first couple of stages is the bankers say, right, I'm going to ignore this. Then there's anger. Then there's bargaining. The banks say, okay, I can't ignore this for much longer. I'm not going to be angry. I'm going to go and, so the bargaining stage, I'm going to invest in fintech. I'm going to put money into it. And it was around, you can't date this exactly, but if you had to pick a date, summer 2015 is as good a date as any for when bankers decided, in both Europe and the US, to take fintech more seriously. And you can see funds, VC funds going into FinTech jumped significantly. In 2013, there was hardly any VC investing in FinTech, less than $4 billion. 2015, it's $14 billion. It's a big jump. One of my VC friends came back from holiday, summer holiday in 2015. Before he went away, and he's in one of the northern European countries, very tech-savvy country, he said no banker wanted to talk to him before summer 2015. When he came back after summer 2015, every banker in that country wanted to talk to him. So there was a kind of tipping point, and we're sort of 2-3 years past that tipping point now, of banks saying, we can't ignore it, we can't get angry about it, we're going to bargain about it. And obviously, with bankers getting interested in FinTech, where do they put their money? Where did they see 10x solutions, particularly in the more developed markets or money centers? They see it in B2B. So what's really interesting is that in this time zone, most of the investment goes into B2C because there are significant 10x opportunities in B2C. But when you look at North America right now, or last year, the data we have, by number of investments, half of it's going into B2B. It's a big, big difference between what's happening in Europe, or at least Northwest Europe, North America on the one hand, and Asia. Asia's obviously, the numbers are very driven by China and India. So a lot of numbers on this slide, and you probably can't see it from the back of the room. But the point here to look at is, if you're investing in this space as a new entrant, as a FinTech or a tech fin, or you're trying to defend, you're playing defense as a traditional bank, where is the money made? Because it's great to talk about, I'm going to disrupt the financial sector industry, but you've got to focus on where do banks make their money? So if you can't see from the back, let me explain the bottom table. The bottom table shows you where we estimate the global banking industry makes its money. So the middle column is lending at the bottom. Between SME, personal, and corporate lending, 50% we estimate of the risk-adjusted revenue pool, so revenues minus losses on loans, about half of the banking industry's profits get made in lending. Now, obviously, that lending requires more capital, so the ROEs are not as high as in payments. But payments, which is where a lot of the tech companies get excited about, payments only accounts for 7% of the bank's risk-adjusted revenue pool or profit pool, 7%. Now, from a purely financial perspective, if the tech industry come and took all the payments in the consumer space away from banks, in itself, it's not a game changer for the financial services industry. The risk is, if they take the payments away on the consumer side, that 4% goes, but then they become the gatekeeper. So whether it's a Facebook or an Ali or a Tencent becomes the gatekeeper, and then they choose, okay, you want a loan, you want a mutual fund, I'm going to distribute that. I'm going to replace the bank as the intermediary. Ultimately, banks are two things, intermediaries and a mechanism to transfer risk. So it's not, payments isn't the real risk in itself from a financial perspective. It's the knock-on, indirect effect of losing payments. Lending is where the money is made. And so not surprisingly, a lot of money goes into FinTech companies focused on lending. A lot of money goes in. And it's particularly true in Asia, but it's a global phenomenon. Now, the problem with this is that the revenue pool, risk-adjusted, the profit pool is huge in lending, so everyone's getting into lending. All these companies come along, they say, hey, we're a really new way of doing credit. Now, some of them are innovative and different, and each of you will have your favorites. In Europe, for example, what Klarna did on e-commerce was really interesting. A lot of people love Credit Karma in the US, but a lot of this is hype when it comes to lending. And these companies, these lending or marketplace companies, when they list as internet or new age companies, and they die as credit companies. So when they list, they go and they find my counterpart in the tech team in research or the internet team, and they get listed by those guys because they put companies in multiples and revenues. And then they run into trouble, and then I guess we're like the undertakers, and we come along and go, oh, shit, that's a problem in the balance sheet or problem in credit, and they die as credit companies. And this is a list. If you can't see from the back, all you need to know is that the dark blue bars are lending companies, and the light blue bars are payment companies. And what the bars show you is the percentage change up or down since they IPO'd. Pretty much all the dark blue bars are down. So this is a major problem now. So what have I been saying? Lending is the biggest part of the industry. So a lot of VC money goes into lending. They grow. The business plan is, oh, we're doing credit in a really neat, novel way. We're tracking all your data on your mobile phone, and for your social media connections, we can underwrite better. I'm obviously simplifying and generalizing. Then they come along, and somewhere along the process, their credit losses are higher than expected, or usually what happens is the government says, hang on, this just looks like a slightly more technology-enabled view of money lending, high-margin money lending. We don't like it. We're going to put caps on interest rates. And regulation becomes the biggest challenge to the business. Meanwhile, the payment companies, and if you can't see in the back, the companies are WorldPay, Square, PayPal. The payment companies are generally they've done quite well. There are not many insurance or asset management companies that are listed yet in fintech space, but that's probably also balance sheet-like companies, truly balance sheet-like companies are going to do really well. Now, just a couple of points to finish up my presentation. I'm going to talk about two areas that are potentially very interesting from both the bank side and the fintech or the tech fin side. One is AI, and I'm going to wrap up and talk about digital assets. So there's a lot of interest in AI from the bank's perspective for the obvious reason that to a large extent, most banks, particularly retail and commercial or transaction banks, are white-collar factories. They have a lot of people doing pretty mundane processing or manual jobs that can be automated. And there's a great quote from John Cryan, the CEO of Deutsche Bank, at the top left-hand side. We're too manual. It makes you error-prone. It makes you inefficient. Errors, inefficiency. If you can automate this or increase automation, that could be a silver bullet. Now, banks, not surprisingly, are the biggest, I put it in inverted commas, biggest client of the AI industry. This obviously excludes the really AI companies. So if you're one of the bats or one of the fangs or gaffers, you do your AI investing in-house. You don't bring in consultants. You don't show up in this data. So if you leave out the sort of, if you like, the cutting edge of AI companies, you go to the rest of the world. Banks spend the most amount of money on AI, and it's growing rapidly as well. It's growing at a significant double-digit pace. One area that's obviously a use case already in large parts of the world for AI is chatbots. Another area, actually there's loads of areas that are use cases. I won't, if you're interested, I can send you this presentation, but there's dozens and dozens of areas across different product areas that banks are looking at. But the challenge banks have with cracking the use of AI in the next 2 or 3 years, particularly in the retail and commercial bank, is data and product management cycles. In capital markets, in the next 2 or 3 years, AI is probably a better use case because in the capital market divisions, there's huge amounts of data, short-term data, but vast quantities that can be analyzed, particularly from a compliance and risk management perspective. And that's where the banks have been for the last 10 years spending more and more money and throwing more and more bodies into compliance and risk management. So but in retail and commercial banking, getting data out of your systems, out of your, I showed you that spaghetti, the Rabobank chart before. Getting data out of your systems is well nigh impossible. But in capital markets, in the wholesale part of banks, there's a real opportunity. Just a couple of words and a disclaimer. We use these guys, and Citi has invested in them as well. So it's a PR disclaimer. But Behaviorx is an AI-based company that has about 20 or 30 capital market clients, not just Citi. They started out with hedge funds. A lot of the major banks are using them. I'm told every single large UK bank is trialing it, at least on a trial basis right now. What is the problem Behaviorx is trying to solve? Just to wake you up, one last question from me. How many people does JP Morgan have working in compliance and legal? I'm not going to ask Citi because that's too close to home. And 5,000, says Claire. Higher. 30,000. Whoa, that's the Citi number. JP Morgan, so it's obviously bigger, right? So 40,000 people inside JP Morgan do some kind of legal, compliance, supervise. These are people watching other people. These are not people talking to clients or analyzing credit risk or market risk. It's a bit like, it kind of sounds like East Germany, right? Or North Korea. There are 40,000 people inside JP Morgan and not so much smaller inside Citigroup, just watching what other people are doing. So what are they doing? So when I do this presentation, they read it. There are millions of phone calls made every day by big banks. They go through the phone calls. If there's a fraud or a problem or an insider dealing case, like recently there was one around a company called Cheesecake Factory, right? So poor compliance guys have to go through these tapes, emails, looking for all references to cheesecake, right? What happens? They get thousands of references to cheesecake, most of which are about, friends talking or spouses or families. What this does is they use machine learning, natural language processing, and they just go through all this data. So on a daily basis, Behaviorx goes through about 26 or 27 million emails and chats. So, WhatsApps or WeChats or emails, and about 3 million or so phone calls. And it analyzes, and it saves that compliance guy or girl going through this mundane task of looking for, the right reference to the Cheesecake Factory. So there are real use cases today for some of the more smarter technology, and capital markets is a really good one, but they're kind of narrowly focused. But in the wholesale space, think of the savings that over, say, the next 5 or 10 years they could generate in terms of headcount reduction, or better still, fines minimized. So that was AI, a brief full-stop tour. And the last where I'm going to stop is, last topic is digital assets. Sorry, I'm just going to flick through. Okay. So digital assets. So for me, the interesting thing is, I guess no one's missed this, right? But what's really interesting is people keep asking me as an analyst, how do I value these things? And it's really simple. Have you seen these Google charts? This is the Google search data. So the top left-hand side is Google search data for Bitcoin. Previous page, top left-hand side, Bitcoin share price. I'll let you kind of overlap those pages later on. So page 49, top left-hand side is Bitcoin price. It's come down a bit further since then. Google search. There you are. So that's digital. I mean, obviously, senior bankers hate it. I mean, you've all seen comments from, which he regrets now, from Jamie Dimon about Bitcoin. So just for fun, as we're, there is top, worse than tulip bubbles. Senior bankers hate it, but banks' clients are really interested in this. So what's going to end up happening is we're going to end up with a Lloyd Blankfein quote. Still thinking about it, no conclusion, not endorsing, rejecting it. But basically, if our clients want to use it, we will trade it. In the short term, blockchain might be a really interesting technology, and you've heard about blockchain in many presentations. In the short term, blockchain remains pretty much, whether it's in the transaction bank or other parts of the bank, at a proof of concept stage. The only real use case in the last couple of years has been crypto trading. And this is probably where I'm going to stop in terms of thinking about the value. Sorry, I'm just going to go backwards. This one, yeah. So the value is, the problem right now for the banks or for the VCs in particular, when it comes to blockchain, is that the value is so the economic value remains in the underlying protocol rather than application layers, companies that are building on the application layer. That might change over the next 5 or 10 years. But in the short term, this remains really a play on the underlying protocol. And if it's a play on the underlying protocol, you're probably better off trying to predict where Ethereum share prices are going to go rather than looking for business use cases. On a 5-year view, if I'm still invited back to such conferences, you probably, best scenario you could see is it's used in certain parts of the trade and cross-border payments channels. On a 1 to 2 year view, if you're a small financial institution, you can remittances, particularly in non-orthodox corridors, that's where you'll see it. And I'm out of time, so I'm going to stop there. It's been a long day for you guys. And if you're interested in following what I write about, you can look this up, my details. You can Google me. This is available publicly online. Thank you for listening. And if you have more questions, join me at the drinks afterwards.
Thank you very much.